Good afternoon, ladies and gentlemen, and welcome to today's stock market brief show. I got an interesting chart here dating back 16 years. We got a signal that's only happened twice. So I'm going to be going over that. But more importantly, in today's stock market brief show, we got to talk about CPI because that is right around the corner. Doing so, we're going to be looking at expected moves. We're going to talk about market conditions and then obviously dive into some of these signal charts. We're going to top it off with a big picture chart because I think it's very important to understand the bigger picture of what's going on to be able to trade tactfully in these smaller time frames. If you haven't done so already, make sure to like and subscribe. Leave a comment below. Let's get into today's show. All right, people, welcome back. We're going to start off here. We got core inflation data coming out an hour before the market opens up. Most importantly, right, is whether we come in above or below consensus. Now, there is some charts floating around the space that suggests that inflation will be coming off, potentially lower than expected, which could be good for the overall market. Here's a chart of true inflation. This thing dropped off a cliff. So we'll see here, and more importantly, how the market wants to digest that information. If it does come in lighter than expected, which is what the Fed has been wanting to see, right? The last report came in hotter than expected. So if it starts to come cooler than expected, perhaps the market starts to price in maybe a rate cut starting here in May of this year. As far as right now, this month, March 19th, we have a meeting. There's about a 97% probability that we will be cutting or keeping rates where they currently are. So we'll watch to see how the market kind of interprets this. As of right now, they're looking at about 3 rate cuts for the remainder of this year. You can look at the 2-year Treasury yield, and it typically has a good sense as to when the Fed is going to cut rates. You can see the blue in the background, how typically it starts to fall off, and that's when the Fed starts to hold rates where they are, and then it leads where the Fed typically does. So if you're interested, right, you can always watch the 2-year yield and a response, but you can see back here, 2006 to 2008, right, the yield was falling. They kept rates the same. It was signaling that they'll be cutting rates. Same thing over here, which we're currently going through. Now, there's a lot of volatility in this market. We know this. We've been talking about the VIX futures curve, how it's been in backwardation, right? The other way is contango, where you can typically see things out in the future as far as risk. So right now it's telling us, hey, we got things going on right now. And in fact, we've been actually below the gamma flip line for I don't even know how many days now. It feels like forever. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trading days so far. And when you're below that gamma flip line, volatility typically increases. But we've been noting these last couple of trading sessions how we are getting rather oversold here. So I think that might be important to understand the potential for a bounce. And when you look at the VIX volatility index, we did creep up to and around that 30, and so far we're backing off slightly. And if we can get through CPI, PPI, right, this should allow some of this volatility to start to contract, which could lead us to a nice little bounce here in the market, some relief, which we just really haven't seen. And that kind of brings me to the market conditions. We haven't seen any sort of relief, right? We've been basically one-way ticket down into this lower level here of the JPM collar, and it's still currently holding. The gamma flip line is roughly at about 5,800. We're going to talk about expected moves in a moment here. And when you're below the gamma flip line, volatility, like I said, typically increases. Buyers buy, you get selling into selling, buying into buying, right? So you get violent moves in both directions. And if you're one of the more tactical patient traders, since we've been below the declining 5-day moving average, you've been probably just postponing, waiting, or trading tactically extended areas. But we still are below these declining 5-day moving averages, which means what? It means it's going to take time for the market to start to correct and heal and potentially give us insight that there could be a bottom. Not the bottom, but a bottom, right? We don't know if it's the bottom until later, right, in hindsight. So keep that in mind. We'll go into the expected moves here. I'm going to go ahead and give you something. I'm going to give you all the expected moves for the index products that I trade. I typically post these in the Discord as one of the many benefits there for the $9 a month, or you just pay the entire year and get a discount. Ends up being like $90 US. But we got the SPX. You can screenshot this. This is where it closed. These are the daily implied moves here. So just take a look at SPY and Qs. They're $8 and some change You got the upper levels, right? And then you have the 2 standard deviation levels. Think of it in terms of a distribution curve, right? 68% of the time we'll finish and or tag really within these areas here. And by the way, we did tag perfectly the SPYs to an extent perfectly, right? The lower EM today, and it bounced from those levels. And then we have our 2 standard deviation levels, which 95% of the time will close within that range of itself. I'm also supplying you with the expected moves for some of these mega cap stocks. We got Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. Okay, so you can see their upper levels, lower levels, and you can put these on your chart. You don't need a trade off of them, but maybe see if price can reach up to these levels and see how they respond, see how they react. I always use these as a good idea of what the market's trying to handicap for risk. Okay, we'll take a look at the SPY right now and give you an idea of what it looks like on the chart. The daily expected move is down here at about 547.50 and a little slightly lower there with the other implied vol range there. And if we were to sell off and come into these areas, that's going to bring us down into the expectations of what was really met for the quarter. Now, today, we did see some positive move, right? We came down lower into the daily implied move. We saw some strength back and basically got hung up right here at the week-to-date anchored VWAP. Now, that is going to be an important level to reclaim. And the reason for that is because this was a very large selling day with some strong volume behind it, okay, which was the start of the week. So to feel more confident, even in the shorter term, you'd want to be back above these levels here. And that would also put us back into the weekly expected move because we're currently outside of it. We got back in it and we saw a little bit of a sell-off here as the market's prepping for the CPI data. Slightly above that is the lower month to date. So if the market loves what it sees tomorrow, we can potentially rip right back up and maybe come and retest this lower month to date and see how the market kind of responds to a declining 5-day moving average at that time, right? Other than that, if you're trying to be patient, right, if we come down or move around or whatever the case is, right, watch for the 5-day moving average to eventually start to flatten out to turn back up. Now, I want to hop into some of these signal charts because things are getting rather frothy, which gives me the sense that this bounce that everyone's looking for and searching for, it could be very well right around this corner as volatility, as this implied volatility starts to come off a bit after we get these reports, right? It depends on what the market interprets it from these reports, but that's kind of the narrative there. So bullish percent index for the Nasdaq Composite, right? This has been coming off quite a bit. It's at its lowest level since 2023. And the RSI, it's no longer a positive divergence by any means, but it is in oversold condition. This is a pretty broad market. So after this sell-off, I'm actually kind of surprised it's not a little bit lower, but it is still a lot lower than prior areas where we've seen some minor sell-offs there as well. The NYSE bullish percent index has been coming off to a level that we haven't seen since 2023, right at around that same time where we went through this correction right there, which by the way, the S&P 500 reached into correction territory today. And we have the RSI that's rather oversold there with a bullish divergence currently building out. And I want to reiterate that oversold can remain oversold, all right? But it is important to continue to watch this stuff because there will come a time where we come back up and we get back to overbought and we bring it up every single time it happens. Bullish percent index for the S&P 500. This one is not nearly as hit. So we took about a 10% correction and we're still really holding up rather well. You can see here that we do have a higher low in the RSI. So if this comes off a bit more, we can see a potential positive divergence build there. But this is, I mean, we were lower here at the start of the year, and clearly we're at new lows for the S&P 500, which just tells me that there's been some stocks that have been holding up. Bullish percent index for the NASDAQ 100. So tech stocks, right? This one's as low as it was right there in the start of 2025. And you can see that it's also been pretty low in August and really low there back in earlier 2024. And as this is coming off here, it could potentially create some sort of a positive divergence in the NASDAQ 100 there. Bullish percent index for the S&P 100, the largest market cap names in the S&P 500, also coming off, but really after a strong sell-off, we're not really even that extended there. Discretionary has got rather extended because, well, Tesla fell 40+% from its highs, and Amazon's been getting hit. So a lot of the discretionary type names, right, have been coming off. And we haven't been this low since, well, 2023 here around that October, November level. And the RSI is putting in a positive divergence. So are we going to see some bounces in some of these discretionary names? Financials also been taking a rather big hit, a steep decline creating a positive divergence here too as well. I'm pretty blown away. JPM, that thing fell just about 20% from its high. So going into that quote unquote bear market territory in a very, very short amount of time. So is this just a random pullback or is it something a little bit bigger? I mean, we'll know in hindsight, but that is no joke of a fall in a very large, important bank in a very short period of time. Okay. Transports. This one is very interesting, but we had a 10% reading over here, which we haven't seen since the 23rd. And you can just go back to the left and like we're dating back multiple years here, but it's not too frequently that we actually come and test these specific levels. So transports has been selling off pretty hard here. And you can see we have a bullish divergence currently in the RSI there too as well. Now, this is the one that I talked about when at the very beginning, basically saying like, hey, I've only seen this happen now 2 years in the last, or 2 times in the last 16 years. So the bullish percent index for technology, right? We know that various technology names have come off and they've come off hard and fast. So you can see the XLK sector up here, how it's been selling off. And this, right, we were looking at when it was at 25. We're like, that's not that low, but 20 right around here would match these levels. Well, this is the level 15. And well, you can see in the last couple of years, we have not been here. And then the RSI is getting a reading of 1698. So it's a pretty oversold condition. So what I found interesting here was, well, when's the last time that we had an RSI of this type of low of a reading with a bullish percent index that was this low as well? So I date back 16 years, right, to 2029, or sorry, 2009, and you can see the highlighted green, right, is when we had an oversold condition here at about 15.49% on the bullish percent index with an RSI this low. And you'll see that there's been other times where we got very low readings, but the RSI wasn't down there. So it's still an extended reading by all measures here, and it's still important to watch, but I'm just trying to find similar points in time. And if you go to 2020, this is the pandemic low, basically. We had that RSI reach down into those low territories, and you can match it up here with the reading that got actually down to and around 1% or so. So basically all the stocks got hit rather dramatically over there. And then we started to find some sort of a bottom. Over here in 2019, the RSI actually was not there, but you did see a bullish divergence form as we crept into that new low. That was the Christmas Eve massacre of 2018 going into the new year of 2019. Now you might be thinking, well, what happened over here during the Great Recession or the financial crisis? Well, here you go. I put in the dot-com bubble and I also put in the financial crisis, and you can see that there's only a couple other times, right? So this is now dating back to 2000 where we saw 3 other times that this has happened where you get an RSI rating this low, as well as accompanied by a reading of the 15.49% or lower. So you see over here in 2008, the market sold off. We saw a nice rally, and then it ended up turning into the great financial crisis, right? So over here, we got a really extended reading with an RSI down past these levels, even more so extended. And this wasn't even really even the low in the great financial crisis, but it was near it. And it took some time for it to start to base out, seeing some big moves to eventually find a bottom. And then here in the dot-com bubble bursting, it actually took really quite some time to really get this index to have an oversold rating on the RSI, as well as this extended of a reading on the bullish percent index. It was right here, basically at the lows, where we saw a rally from this low print back up here, and then we started to continue more to the downside. So can you do anything with these charts? I mean, I think it's more of a giving you more insight that's saying, hey, the other times that we've gotten stuff like this, it's very extended, and we're looking at some other signal charts that's saying, hey, things are getting pretty frothy. In short, what it tells me looking at this is we very well can get a face-ripping rally, but it doesn't necessarily mean that the pain is completely over. We're going to need more data, and we're going to go into the big picture chart momentarily, and I'm going to tell you how to kind of navigate that. If you take a look even back further, right? So I had to pull the NDX on this one. You can see that the last time prior to the one that we just went over was one more time down here in 1998. And that was right here where we're seeing some turbulence before going on a monster rip there too as well. So this is dating now back to 1996, and we've seen it 1, 2, 3, 4, 5, 6 times only in the last 30 plus years. Okay, so pretty impressive stuff. Okay, now with all that said, those are some of the risk on type assets that have been getting oversold. Take a look at risk off assets. This is the consumer staples bullish percent index, and we have ourselves a over condition on the RSI with a bearish divergence. So is consumer staples going to take a little bit of a breather while some relief takes place in the more risk on assets? And I think that that's potentially a possibility that we got to watch out for because, well, we've sold off very hard, right? So take a look at the Qs, right? The Qs have came off hard and fast, pretty much in a straight line. You can see that if we measure out growth versus value, and we have the Qs up here, and you look at the rate of change, when it actually slips into negative rate of change on that 10-day rate of change, you can actually just zoom up and you can see it's actually acted as a good sell signal multiple times. Right now, we actually have a higher low in the RSI with lower reading on price action, which we've seen that actually right here going into August, lower reading on the price action, but a higher reading on the rate of change, leading to some sort of a bounce. But you can see multiple times, you just draw this line straight up, and when it crossed underneath the zero line, it's actually been a decent sell signal, right? Like right over here, right? You saw move down, up, down, and so forth, and so forth. If you go through it, there's a lot of whipsaws, but overall, it does help. And on the flip side to that, if it starts crossing back above it, well, guess what? It's telling us that growth is outperforming value, and we might see a little bit of a pop higher. So right now, right, what are we getting? We're getting that oversold condition, seeing a little bit of a positive divergence. Things are setting up here to have a little bit of relief. So if the market, once again, likes what it sees, it could very well start giving us some relief. And I know that everyone's gonna be like, where can it potentially go to? All right, so we'll really quickly touch on that on the Qs. Where can we see a big move back and start to see like, okay, now be a little bit more careful here? That could be right in and around, I don't have the exact, well, I guess I can bring it up over here. It's about 515, I guess, right here, 510, 515 on the Qs. That would be a back test of this kind of range breakdown. Maybe even just a snag lower where you see this kind of double top and it broke from here. So maybe retesting that specific neckline on the NQ, or sorry, on the Qs. Let me see if I can draw this a little bit better here. So yeah, roughly about 500, 505, somewhere around there. I mean, this right in this area. And then we got to see what price action does after that point. But that's definitely a possibility. If we take a look now at some of the breadth charts, so we're looking at the percent of stocks above the 50-day and the 200-day. This is getting interesting too as well. One thing I want to call out here, the percent of stocks above the 200-day, it's always important to watch for deteriorating breadth, right? So you get a market that keeps on pressing higher and higher. And then what the heck is this doing? Oh, it's telling us that as the market's pressing higher, it's doing so on less stocks. And before it, right, these divergences, they can last for a year, even longer. And boom, what did it happen? It ended up resolving itself to the downside to get to oversold conditions. So right now, we're getting a reading of 41.8, which means that 41.8% of the stocks in the S&P 500 are above their 200-day moving average. So it means more than 50%, another way, is below it, right? And we haven't actually been to this level since 2023 here too as well. So when we start really creeping down into this 20 to 10% range down here, that's pretty darn frothy to the downside. You can see we got down there over here in 2020. And that did mark a bottom with the benefit in hindsight there of the Federal Reserve stepping in. Now, I've been sharing this chart too, because this is why I've been saying like, gosh, like I would like to see this come off more, but it really hasn't. I feel like we haven't had any capitulation, and I still really kind of feel that way. So if I'm looking at the percent of stocks above the 20-day moving average with these various indexes like the S&P 500, I mean, it's still relatively high for what we've been seeing. So this just tells me the market's been coming off because of larger market cap names, right? And it hasn't really gotten everything yet, which is telling me that we just haven't had this full blown out capitulatory move. Oh, I want to call this out that if you look more concentrated and you look at the NASDAQ 100, it's telling us now 16% of the stocks in the NASDAQ 100, right? So 16 stocks in the NASDAQ 100, right? Another way is above their 20-day moving average. And that is getting into more of an oversold condition. You can see that in the NASDAQ composite. So you got more names there that have been kind of coming off as well. But the S&P 500 has been holding up rather well amongst a lot of these other names. So will capitulation come? Will it come? Or will this get some relief like it did over here, right? Like if you look at the S&P 500, right? Let's see. Or even look at the S&P, the small caps, right? It almost came to oversold, but then we rallied really quickly back. So that's always a possibility too. Now I want to start off getting into the big picture chart, and then I'm going to kind of wrap it all together. So the big picture chart, that I think is still important to kind of keep a mind be mindful of is that people typically say that, hey, rate cuts is what the markets want, right? Rate cuts are good for the market. People want that. Well, if you go back through history, that's not necessarily been the case. And you can pair this with the 10-year 3-month yield curve. So we have the rate cuts or the federal funds rate below us, and then we have the yield curve. And I've shown this so many times where you make new highs and people are like, this time is different, this time is different, this time is different, right? But then you start to uninvert this yield curve, it starts to steepen, and you end up looking out not too far longer that there's a recession around the corner. And when we start cutting rates, I mean, look at when we started cutting rates, what happened? Well, the market continued to actually sell off. And it wasn't until the Fed stepped in where we really slam rates and then the market starts to turn up. So the same thing over here, right? We started uninverting. Guess what? The market went sideways, right? This is a monthly chart. It went sideways for a while. We saw a sell-off. We saw it move back up. And then all of a sudden, right, we started slamming rates down to make up for really all this volatility so we can have some sort of a backstop. Okay, same year in 2020, right? So there's a one-off. You can consider a one-off because of the pandemic. But also, we were going into a potential recession. It was telling us that, hey, yield curve's uninverting. Federal's been lifting up rates. We're starting to cut. And then all of a sudden, they stepped in big time when the market reacted to the COVID situation. Now we've had our pretty much longest, one of the deepest yield curves inversions in history start to uninvert here. And now we're starting to potentially steepen, which can very well, right, tell us that the Fed is going to start cutting rates like we've been pricing in. And what are we going to start going through more volatility and potentially land in one of these situations? Now, the reason I'm pointing this out is because it's too hard to sit here and say, I'm going to time this based off of a monthly chart, right? So this comes back to the point of being more tactical when it comes to market conditions. So back, right, before we slipped, when we were basically up here, and even before that, we were basically saying that, hey, based off of this big picture chart, when we start now to slip into poor market conditions, when we get below the gamma flip line, when we're below a declining 5-day moving average, you want to pay much more attention in these markets because of the backdrop of the bigger picture. You need to respect this even so much more given the context of what's happening currently from a bigger picture. That's all I got for you. Hope it helps out. I'll see you later.